Have you ever considered how different taxes impact people with varying incomes, and whether the system always feels fair? At its core, a regressive tax is defined as one that imposes a greater burden, as a percentage of income, on low-income earners compared to high-income earners. This means that while everyone might pay the same dollar amount or rate on a particular item or service, the tax consumes a much larger proportion of a lower-income household's overall earnings. The fundamental mechanism behind a regressive tax lies in its application, which often does not differentiate based on an individual's financial capacity. For example, a sales tax charges the same percentage on a purchase whether the buyer is wealthy or of modest means. If a person earning $20,000 a year and a person earning $200,000 a year both buy a $5 loaf of bread, they each pay the same sales tax. However, that tax represents a significantly larger fraction of the $20,000 earner's disposable income, creating a disproportionate economic impact. To identify a regressive tax in practice, one should look beyond the stated tax rate and consider its economic effect across income brackets. Taxes on essential goods and services, such as food or utilities, often have a regressive impact because lower-income households spend a larger portion of their earnings on these necessities. Similarly, flat fees for services or licenses, where everyone pays the same amount regardless of income, tend to be regressive. Understanding the concept of tax incidence is crucial here, as it refers to the ultimate economic burden of a tax, not just who legally pays it. While a business might collect sales tax, the economic burden falls predominantly on consumers, and more heavily on those with lower incomes. This principle helps reveal the true distributional effects of different tax structures on household finances. Ultimately, recognizing a regressive tax helps us analyze fiscal policy with an eye towards its real-world implications, highlighting how various revenue streams can inadvertently widen or narrow economic disparities within a state's population.